Hello everyone, thank you for joining us in the DEA 2020 conference. Today I'm going to present our latest work. The title is Big Data and Portfolio Optimization, a novel approach integrating DEA with multiple data sources. If you have any questions or comments, feel free to contact us by the following email address. This is the general content of today's presentation. We will first start with the background and motivation. Portfolio optimization has always been one of the hottest topics in the financial field. Ever since the classic mean variance portfolio theory proposed by Markowitz in 1952. This research focuses on how to allocate the wealth among different assets and develop an effective investment strategy. Markowitz suggested that do not put your eggs in one basket. That means for investors, you need to diversify your investments as much as possible to reduce the investment risk. However, in the real investment applications, a fully diversified, or you can say over-diversified portfolio often indicates high transaction costs, as well as a demand of intensive attention on the market flow. So in 1983, Keynes and the co-authors argued that investors should concentrate their wealth in a small number of investment-worthy stocks, thereby reducing the diversification of the portfolios. This investment strategy is called the under-diversification strategy. Therefore, it comes to our research problems in this paper. The first one is the stock selection problems. This is about how to recognize the investment-worthy stocks in the markets, which has a large number of assets. And the second question is about portfolio optimization. That is how to construct an effective portfolio based on the information we have. So in the literature, most of the papers focuses on two aspects of data to find the investment-worthy stocks. The first one is the financial statement data. However, it is clearly that the publishing period of financial data is relatively long, so there exists an obvious time lag. And for the second source of data, which is the historical return data, it is based on the transaction data. Here, the investors use they will choose the stocks based on their historical performance. However, there are scholars argue that a security doing well in the past does not necessarily guarantee its performance in the future. In fact, the correlation between the past performance of an asset and its future performance depends on the effectiveness of a financial market. However, most of the financial markets are not fully effective. So the historical stock trading data may not fully reflect the future investment value of the stocks. In this paper, we focus on integrating three data sets. The first one is also the historical return data. So it's the daily transaction data like opening price, highest price, lower price, etc. But in addition to this, we also use the asset correlation to improve the stock selection performance, and also with the increasing availability of web-based data, investors can also extract the real-time investor sentiment based on the web-based text data. So this will also be incorporated into our stock selection schemes. When it comes to the methodological part, most of the papers use either econometric models or data mining approaches to analyze investment value of the stocks based on these two data sources. But actually, the results of these studies are very sensitive to the setting of parameters and the selection of models. So in this paper, we choose DEA methods, the data investment analysis methods, which is actually a non-parametric method, to avoid the aforementioned problems. So in general, this paper focuses on examining the issue of optimal investment strategies in conjunction with DEA and multi-source data. The main work is threefold. First, we would like to propose a stock selection scheme by integrating multi-source data and by using DEA to analyze the investment value of stocks. Second, we would like to provide a portfolio optimization model based on the proposed stock selection scheme and the stock price movement, which will be derived from the supporter vector machine algorithm. Third, we will conduct an empirical analysis, use the constituent stocks of CSI 300 index to evaluate our proposed stock selection scheme and the hybrid investment strategy. First, let's look at our stock selection scheme, which is based on multiple data sources and DEA methods. As we mentioned earlier, the investment value of the stocks will be evaluated from the three aspects. For the first two aspects, these two performances are all based on the historical transaction data. And for the last one is generated from the textual data, which are the social media data and news data. So for the first two performance indicators, it's quite straightforward to generate from the DEA method. Let's start with the historical return performance of the stocks. So here we use the expectations and variance of the returns as the inputs and outputs of the DEA models to evaluate the stock return performance. If a stock has a higher historical expected return and lower variance, it means that this stock is more possible to have higher investment values. This is actually a traditional method of evaluating the investment value of stocks. Here we use a directional distance function measure to evaluate the historical return performance. And then it comes to the degree of correlation between stocks. When constructing a portfolio, investors prefer to select stocks with a lower correlation so that they can hedge their investment risks more effectively. So in this paper, we use the expectation and variance of the correlation coefficients as the indicators to measure the degree of correlation. So both the expectation and the variance is the smaller the better. So here comes to our main problem is to measure the sentiment performance of stocks. The extraction of text sentiment refers to the use of a numerical value to represent the polarity and degree of sentiment reflected in the text. So here we use the sentiment lexicon method to construct the text sentiment score. The detailed procedures are presented in our paper, and also you will find here in this figure. So the final numerical result is the sentiment score. If this sentiment score is positive, then it means the investor expressed positive sentiment and has a bullish attitude towards the stock. Otherwise, if it is negative, then it indicates the investors express negative sentiment and have a bearish attitude towards the stock. In general, the higher the absolute value of a sentiment score, the stronger the sentiment is. By generating the sentiment score, the daily sentiment scores, we constructed the matrix of sentiment, and eventually we constructed the matrix of the sentiment changes. In the DEA model here, model 10, we use the expectations and variance of the sentiment change series to construct the sentiment performance. So the larger the value is, for the sentiment matrix, it reflects the average sentiment of daily posts. So the larger the value is, the more optimistic the investors are about the stocks. So similarly, for a better sentiment performance, a higher expectation and a lower variance is preferred. After generating these three performance indicators, we constructed the stock selection index here. Stock selection index. Here the I is an indicative function, and here the A, the coefficient, is a predetermined level between 0 and 1. So it can be decided by the decision makers according to their preference. Obviously, the larger the value of A, the stricter the requirement of decision makers, and therefore the fewer stocks to be selected. And in the extreme situations, if the A equals 0, then all the stocks will be selected in the portfolio optimization process, so it will be a fully diversified strategy. And here, if the index is 1, then the stock will be used to construct the portfolio. Otherwise, it is considered it doesn't have enough investment value. So the multi-source data, we not only use the data for stock selection, but we also use the data, multi-source data, to predict the future trend of the stock prices. Here we use the supporter vector machine to predict the stock price movement. Based on the supporter vector machine algorithm and the multi-source data, the stock's price future trend is able to be forecast. And then we can provide investors with a corresponding strategy for portfolio construction. You will notice here, the Fn represents the predicted value of the stock prices from the supporter vector machine algorithm. So it's a 0-1 variable. If it is 0, then it indicates the stock's price will fall in the future. Otherwise, it will not fall. So here, this coefficient phi can be treated as the trade-off parameter between maximizing the stock price prediction indicator and minimizing the variance of portfolio return. So this is a proposed hybrid portfolio strategy. To demonstrate the validity of the proposed strategy, we also provide two classic strategies for comparison. The first one is the classic global minimum variance optimization strategy. And the second one is the equal weight strategy. So here comes to our empirical analysis. Since the high market coverage of CSI 300 index, it means that it can represent the overall trend of the Chinese stock market. So this paper uses the constituent stocks of CSI 300 index as our research objects to verify the out-of-sample performance of our proposed stock selection scheme and our investment strategy. So the texture data is extracted from Guba in the eastmoney.com. Guba is currently one of the most active financial social media in China, where each stock has a dedicated website for discussion and communication. Then investors can post their views on the stock under a specific website. We also collect posts and news of the above 182 stocks from Guba by using the web crawler. The 182 stocks because we exclude the stocks that has missing values. So here we also show the data that we collected. First, we will use the supporter vector machine to predict the stock price in the future. So the 8 months of data from January 2017 to August 2017 are used to train the parameters, and the first 75% of data are used as the training sample, and the last 25% of the data is used as a test sample. You will see that in Table 3, the accuracy of the prediction results are shown. So it's actually good prediction results. This is a setting of our out-of-sample test. We use the rolling window approach. For the rolling window approach, it means that if we use May 8, 2018 as a starting time point, then the historical return and stock sentiment data in the previous M days, the big M days, are treated as a sample of stock selection and parameter estimation. We can then compute the portfolio return on the next trading day according to the derived investment strategy. Here for the window length M, we have different choices varying from 30 to 180. We use two classic evaluation indicators to measure the portfolio returns for our proposed strategies, and also two classic strategies. These two indicators are Sharpe ratio and Sortino ratio. Both ratios are the higher the better. This is a result of the out-of-sample performance when the window length is 30. From Table 4, so this table, we will find that for a given coefficient A, so it means that if we look at the column, each column, the proposed investment strategy, which is the first one, this X return sentiment, it has a higher Sharpe ratio, also a higher Sortino ratio than the other strategies. So here shows 3 strategies. And second finding is that for a given investment strategy, so that's if we look each row of this table, the two ratios tend to rise before falling as the stock selection coefficient A increases. So increases, it tends to rise before falling. So this suggests that in real investment, the underlying assets of the portfolio is not the larger the better. The investors must choose an appropriate number of stocks. This is actually very consistent with the under-diversification strategy developed in the literature. So we also show the results under different window lengths. Here is the result of M equals 60. The similar findings as table 4 can be seen. Also for M equals 90. So similarly, if you look at each column, then you will find that our proposed strategy performs best. And if you look from each row of these tables, you will find that the performance are actually growing better if you increase the value of A. And the same findings for M equals 120, 150, and 180. So the 3 findings are summarized here. First, under diversification matters in improving the investment performance. Second, the proposed stock scheme can actually improve the out-of-sample performance for all different investment strategies. And third, the proposed hybrid investment strategy has a good out-of-sample performance comparing to the global minimum variance investment strategy and the equal weight strategy. We also did a robust test to verify whether the findings are robust for different test data. So the data is from January 1st, 2090 to December 30, 2090. All the other settings are the same as the earlier one, except that the test data is changed. We also show the results of different window lengths, varying from 30 to 180, and it's actually the same 3 findings hold for all the results. So I will just briefly show these results. This is a result of 30 and result of 60, 90, 120, 150, 180. So it's basically the same findings, the same 3 findings. So here comes to our conclusion. Theoretically, this paper proposes a stock selection scheme by integrating DEA methods and multi-source data. This paper also proposes a hybrid investment strategy by combining the proposed stock selection scheme and the stock price movement. Empirically, this paper finds that the proposed stock selection scheme can indeed improve the out-of-sample performance for different investment strategies. And the empirical result also verifies that our proposed hybrid strategy has a good out-of-sample performance comparing to the 2 classic strategies. So that's all for today's presentation. Thank you for your time and attention. Feel free to contact us if you have any questions or comments. This is the email address. So Thank you again for your attention.